Wondering how you should pay yourself? Well, with the IRS requirements, sometimes it can be confusing on how to actually give yourself your hard-earned money. That's why you need to watch this video where I'm going to break down the differences between taking a salary, guaranteed payment, and distributions, and when one or the other is mandated by the IRS. Erica here with Paragon Accountants, here to help individuals and businesses alike to build their financial legacy. So let's begin. First off, you need to understand your business entity. Single member, married filing joint, LLC is a disregarded entity in the eyes of the IRS. And this means you're a Schedule C tax filer and you're being taxed on the net income of the business, which is 100% subject to self-employment tax. No payroll is required and distributions from the business are how you will get paid. Next, we have partnerships with one or more members. Depending on your involvement and operating agreement, you may be subject to what's called a guaranteed payment. Guaranteed payments are subject to self-employment tax, while additional profits made through the business can be treated and distributed as taxable to ordinary income. No payroll is required for a partnership here, but you as the individual member will be responsible for paying the payroll taxes as both the employer and the employee if the monies received are subject to self-employment tax. This means if you are a member of a partnership receiving taxable income from a K-1, you most likely should be making estimated tax payments to avoid a huge tax bill at tax time. Next, we have an S-Corp, which is a small corporation. Shareholders actively participating in this business are required to take a reasonable payroll via W-2 per the IRS. Shareholders may also take a distribution out of the business which are not subject to payroll taxes through the year, but this should only happen after taking a reasonable salary via W-2 first. Last, we have a C Corp. Shareholders who are actively participating in this type of business entity are required to take a reasonable payroll via W-2 as well. Any distributions outside of payroll would be treated as a dividend, which many people will say builds in what's called a double taxation. We won't go into that today, but you need to be mindful of it if you are involved in a C corporation. All right, let's begin with salaries. If you decide to pay yourself a salary from your business, you are a W-2 employee just like any other person you hire. Your company withholds your taxes and pre-tax benefit contributions for you and contributes their portion of employer payroll taxes too. Careful though, as a W-2 employee, you as the shareholder must take a reasonable compensation amount or you can get flagged by the IRS. Basically, the IRS wants to make sure you're not paying yourself so little that you avoid payroll taxes. So let's go into the pros of paying yourself a salary. 1, steady income. You know what you're getting each pay period and you're showing a steady stream of income can also help you when it comes time for financing, like a mortgage loan. 2, less administrative work. This takes all the guessing out of the payment that you should be receiving. 3rd, your taxes are already pulled out of each paycheck real time, so you're avoiding a huge tax bill at the end when you file your tax return. 4, paying yourself the same amount every month can help you better understand your business capital, plan for upcoming expenses, and manage cash flow. Let's face it, it requires you to actually pay yourself, so I highly recommend my clients to take a reasonable salary. So let's talk about the cons of paying yourself a salary. Well, determining what a reasonable compensation is can be hard. You also have to juggle paying your personal bills while keeping sufficient cash flow in the business for operational needs. If your compensation falls outside of what's reasonable range, it may cause a red flag. You'll also have some additional costs for payroll taxes and payroll fees for processing. If you decide to go the salary route, you'll want to make sure you talk with your tax strategist to help determine what is a reasonable compensation. Let's talk about about the next method of payment, which is called an owner distribution. Some might know it as owner draw. An alternative to giving yourself a regular salary is taking what is called an owner distribution. In simple terms, an owner's distribution is what you withdraw from your business checking account. However, owners can't simply draw as much as they want. They can only draw as much as their owner's equity allows. Meet with your tax advisor throughout the year to help you decide how much of a draw you can legally take. Owner draws are also limited to sole proprietorship, partnership, and certain LLCs. If you are an S Corp or a C Corp, it gets more tricky, and you want to meet with your tax advisor to see if a draw is the right direction for you. So let's go into what the pros are of an owner draw. You can pay yourself without having to set up expensive and time-consuming payroll processes. You may not be subject to self-employment tax, which equals roughly about 7.5%. And it helps with cash flow since no other taxes are required to be paid at the time of distribution. Now let's talk about the cons of an owner distribution. By taking an owner's distribution, you delay the inevitable of paying self-employment tax, Social Security, Medicare tax, and ordinary income tax all at the time of filing your tax return. So please be careful with this because you need to be prepared so that you can avoid a huge tax bill. The next con is depending on your business entity structure, where you may be subject to double taxation, like a C Corp, who's subject to not only the corporate tax, but a dividend tax for those distributions. Next, we have what's called a guaranteed payment, which is an IRS term defined as a payment to a partner or a member in an LLC for services rendered without regard to income. This acts like a salary in that it becomes an expense of the company. Now let's jump into the pros of taking a guaranteed payment. This is a fixed amount that you can budget for. There's no need for payroll services or payroll taxes because it's passed through onto the K-1 of the individual member who's receiving those guaranteed payments. What about the cons? Payroll tax liabilities are due on the individual partner's tax return or member of the tax return. This can be expensive because you haven't planned for the total tax liability both as the employer and the employee plus your ordinary income. So again, if you're taking a guaranteed payment, you should be making estimated tax payments to avoid a huge tax bill at tax time. So what's the best way to pay yourself as a business owner? My answer is it depends on your personal circumstance. So talk with your tax strategist to help you get paid the right way. Thanks again for watching, and remember to follow us on social media for more financial tips. Please like our page, subscribe, share the video if you know a business owner who's struggling with this question.